Okay, fantastic. Thank you very much, David. It's an honor to be here at Synergy Traders, event number 39. I guess we were at event number 1 8 years ago. And today, what I'm going to be talking about is zero-day options trading strategies. So let's get things kicked off. So who am I if you have not heard of me before? Again, my name is Doc Severson. I'm an individual trader. I quit my six-figure job back in 2005 to do this for a living. And about 6 months after that, people found out that I'd quit my job and was trading for a living at the time. So they beat a path to my door almost at gunpoint. I was forced to be a trading coach. Actually, I really enjoy it because one thing that you note that after you go solo, all of a sudden you go from this whole work family that you're used to. It's half your social life. You spend most of your life there, and all of a sudden, boom, it ends. And all of a sudden it's just you and the dog in the market. And so it was, it replaced that sort of social element, having a community out there to work with and help. And I really enjoy it. So it's really made these last several years a lot of fun. Current services that I run are ReadySet.trade and ReadySetCrypto.com. And I have been involved with other firms such as Options MD, TradeOutLoud, Doc's Trading Tools, Options Linebacker. And my specialties are fractal price analysis, multiple time price analysis, options and future strategies. And out of my own necessity, understanding the trading mindset and all the strange things that we do. And really ultimately simplifying the complex. My background is engineering, so the whole idea there is to take this complicated mess and try to make some order out of it. And to that end, what I've done is tried to apply a little bit of order through a couple of books. One is Hacking the Holy Grail. This is about the trading mindset and how to attain that. And the second book here, most recent one, is Fractal Energy Trading, came out a couple of years ago. And this is to the point of multiple time frame price analysis and understanding how energy affects the various time frames. So those are available on Amazon.com if you're curious. Okay, what are we going to do today? What is my purpose here? Other than you playing hooky from work today, so my purpose today is to educate you and inspire you and show you that you can do this. I want to see the little guy win without getting stepped on and without thinking that they have to join some kind of herd or some black box program or follow some kind of wild subreddit to win trades. There's also something very compelling about being flat by the end of the day with zero overnight risk in today's environment. A lot of people are still carrying some pretty heavy bags from January. And this is a market that was so easy to trade all of a sudden has become so difficult for so many people that got caught on the wrong side. So zero-day option strategies are one of the best natural edges that I've seen in a long time. And my purpose today is to help make you aware of them, show you some setups, and in general, help you decide if this is something for you or not. Okay, ready, set, let's get going here. So why we're here today, 99.9% of people here today are trying to set themselves up for financial freedom. But the problem is using yesterday's methods won't work anymore. We still see examples of yesterday's methods on just about every TV commercial that's out there. Hey, yeah, we just use our managed funds and it'll be all right. Well, what we're trying to do is ultimately grow the pile. This is the old paradigm. Continue to build your pile of assets, and then what you can do is you can live off the interest. The old standard was to build up $1 million and then live off of 50K a year, because cash markets were paying 5% APR. So once you accumulated enough assets, you could safely live off the interest without dipping into your principal. Well, that's gone over the last 20 years as we've gone towards zero interest rates. And even though rates have been on a bender to the upside lately, interest rates are still way below inflation rates. So it doesn't matter, we're way behind what's going on. So the problem here is that we're getting stagflation again. Inflation rises, growth slumps, stagflation makes it very difficult for the average retail investor to stay ahead of the game and to be able to cash flow their pile. Now, there's current alternatives out there other than interest. So you can use things like annuities. You'll hear all these very sophisticated sounding commercials about annuities. They lock you in for years and you get a tiny rate in exchange for them using your money. Or you could go into bond yields, but again, bond yields are 3% annual percentage rate on the 10-year note. That's not going to get you where you need. Stock dividends can be upwards of 7%, but you're going to pay for it with a lousy looking chart, and you're going to, dissipate capital with that. The paper losses are going to continue to mount up in exchange for that yield. So the usual alternatives to creating income are terrible in today's market, or terrible if you're Charles Barkley. So this means that most are not prepared for this new reality. So you can follow the old paradigm of growing your pile of assets, but being able to make money on your money is no longer there like it used to be. So what's going to happen here is retirees are going to be shredding through their principal in no time and wondering what changed, even though this has been happening over the past 2 decades. In the words of Private Hudson, what do we do now, man? Game over. Well, I don't think so. I think there's new methods that we can use, just that most people don't know about them. So income is going to come to the rescue here. Income is what we once received through interest, dividends, and bond yields. How can we replace it and be more effective? Well, we want to search for passive income, which is earned without active participation. This was interest and dividends, or we can use active income, and that requires our participation and effort to earn that income. So you can typically think of this as like a job or active trading. So the question on the table is, are there different forms of passive and active income that can work to replace the old vehicles? Well, yes and no. So first of all, can we use stocks for that income? And I would say no. After a 13-year run, stocks are shedding their excesses. The market is going bear right now. So stocks are trending lower. If you haven't noticed, we're down more than 20% right now on the year, likely entering a time-consuming bear market. Most of these last about 1.5 years. So we'll probably get some type of grinding, hope-inducing summer rally, which is just going to, give way like quicksand at some point later on as we get into the second phase of the bear. This is not going to be pretty. This is not going to get fixed overnight. It is difficult to earn income while holding a depreciating asset. That's not easy if you're just trying to make income off of stocks. So you can trade the market leaders, or at least the former market leaders like Apple and Tesla, but they're already down as well too. So even some of the energy stocks that were so strong until as of late have started to melt down as well. So how can you create income trading in and out of them unless you're net short? And I don't recommend that for most people. Plus, it's hard to do with a retirement account. So can we maybe day trade stocks? Well, it's not a viable alternative, especially for those of you with small accounts, less than 25,000, which is not really that small anymore. We've got this thing called a pattern day trader rule. And that's going to limit the amount of trading activity you can do in the space of a week. So day trading stocks requires too much capital, too much trading, and pattern day trader rules are too restrictive. So I would say stocks for income is not a great idea, but we can use options. Options allow us to replace our interest income from the old paradigm. Passive income, we can sell longer term options to act like an insurance company, where we're selling the risk premium to buyers. Somebody's buying it, we're selling it. And we can also create active income. We can look for short-term opportunities to either buy or sell options using the leverage of options to more efficiently use capital. So options are the answer. My assumption is, since this is an advanced trading webinar today, I'm going to skip the usual background on options and get right to the strategies. So the challenge on the table for us through the rest of the next few minutes here, how do we generate active income using 0 days to expiration option strategies? So that's why we're here today. Now, one of the things that I want you to focus on is a lot of people say, well, okay, here's my level of W-2 income. And what I want to do is to be able to just stop that and then generate the same level of income or more through trading activities. And unfortunately, it's not quite that easy. I think a lot of people that have tried this have found out that usually instead it starts working like this. So what you have to do instead is, it's like any other profession, you have to work your way up. You have to work your way into it so you can earn the right to do that. And the concept I want to bring to your attention today is earning $100 a day in income. Now, what's this methodology behind creating income? So we focus on $100 a day at ReadySet.trade. So it doesn't sound like much of a goal, especially for those of you earning more right now. And you've also got vendors screaming about crushing trades and making thousands a day in their trading room. So it's very crowded, very noisy space. But my point here to you is that you've got to start somewhere. Most people that I talk to, I've talked to traders now for the last 15, 16 years, just about on a daily basis. And it all sounds like they're coming from the same place. Each and every single one of them that is struggling would give anything for some level of consistency. After a while, what they realize is like, look, I bought into all that hype about making $1,000 a day and everything. And all I'm doing is I'm losing $1,000 a day. Doc, I would give anything for consistency. So again, you got to start somewhere, even if it's $10 a day, get to $10 a day, $10 a day, just, like clockwork, like an ATM, and then get that to $20 a day. Or if you're a little bit better, start at 100, get yourself to 200, get yourself to 300 to 400 to 500. It's a process, and it starts with the power of tiny gains. We've all heard about how compounding can be extraordinarily powerful. Now, what if I were to ask you to say, hey, could you get 1% better at your trading between now and tomorrow? And I think most of you out there listening right now would say, well, sure, I could do that. I could get 1% better. I'll put in a little bit of study. I'll create a little bit better tools. I'll refine my plan just a little bit better. And yep, I can dedicate towards getting 1% better tomorrow. So tomorrow comes along and I say, hey, how'd you do? Oh, I'm definitely 1% better than I was yesterday. Okay, now do it again. And again, and again, and again. Do it every single day. Get 1% better every day. If you do that, the power of tiny gains says that 1.01 to the power of 365 means that you're going to be 3,700 times better at something after the course of a year. It's incredibly powerful, right? Now, if you get 1% worse every day, let's not go there, right? It's incredible how compounding can work either for or against you. And so you've got to decide right now that compounding is going to work for you. You're going to have a realistic goal. You're going to chip away at it. And you're not going to do this typical thing that most people do, which is to invest in a program, take a couple of trades and wonder why they don't work. And so you're going to see this bright, shiny penny over here putting out somebody's got a new strategy with a new indicator. So you go thundering over to here and you sign up for their program and you take a couple of trades. And guess what? Probably not going to win the first couple of trades that you take because you don't have the background for it. You don't truly understand it yet. But still, we're disappointed. So we see this other bright, shiny penny over here. And we go thundering over here to sign up for that. We're putting on another credit card so the wife doesn't see it and doesn't ask us, like, what's wrong with the last program? We've all done this, right? We take a couple of trades back here. Hey, this isn't working either. So next thing you know, we're back to square one. And we go in these big orbits like this all the time. We just go into one program to another, to another. We're searching for the Holy Grail where it's right in front of us in the first place. So it's about figuring out what you want. This is what I call your one trade. Figuring out what your one trade is. Pick one thing, start with a modest goal, continue to improve on it every single day. The great thing here with trading zero DTE options allows us to get lots of trades and potential improvement over the span of a year. So we don't have to wait a month to see whether or not we're on the right track with this. We can see today what's going on. Now, the way that we break this up is that we don't use our entire account for these types of things. And I don't recommend anybody to do something like that. So we use it based on a pyramid. So the larger, slower, less risky combinations of trades, we have down here as our foundation. So these are typically non-directional index trades. These can be Iron Condors, calendars. We can be selling puts against the market, things like that, that are relatively quiet, relatively low maintenance. And then we can actually spice things up a little bit with equity trades using the same kind of strategies. And then up here, we get to our directional options. And these can actually be non-directional options, but these are more using a lot less capital. These are intraday. And then at the very top of the pyramid, if we're going to go directionally, this could be futures contracts or just about anything else. It's higher risk, smaller capital. So we use a pyramid-based approach on this. And we also split things up based on everybody's got a different level of capital. Everybody has a different level of time available to be able to pursue trades. And everybody's got a different level of knowledge behind things. So it's this kind of combination of these three things, this sort of Venn diagram intersection in the middle is what we're shooting for, is to get the biggest intersection that you can between these. So it doesn't really matter that much in terms of capital. Time can be a limitation, but actually what I do with my own trading is I try to compress everything into very small time windows. What I've learned is that sitting in front of a screen all day long, trading all day long is actually detrimental. It goes against you because there's only so long that you can fight off that lizard brain, which wants to go along with the crowd. And then knowledge, of course, is limitless. So everybody's got a certain level of knowledge, but everybody can attain more. So this is essentially free and is the most impactful of the three. It's not necessarily capital. I can show you people with 7, 8 figures that lose money every single day. And I can show you people with very small accounts that are very focused, very disciplined, and are very effective traders. And not everybody needs all the time in the world to do this thing. A lot of, when I was working at a job and had a career, quote unquote, career for that, I always felt that, man, if I could just trade all day, I'd be able to make as much money as I wanted. And it's not necessarily the case. It can be, like I said, can be inversely proportional to the amount of time that you put into it. So this is going to be different for everybody. And so you have to ask yourself, where are you starting from and where do you want to go? Now, things are a little easier with larger accounts than I would say in a bull market, right? So we could just do some passive income trades like cash secured puts as long as markets are advancing. But that requires a lot of capital that exposes us for weeks of time risk and it exposes us to bear markets. So not a good idea right now. So what we'll focus on today, the rest of this presentation, is active income using 0 DTE options, which I'll define in a minute. We're going to place these and remove them in the same day. And if we only do them 3 times a week, we can avoid the small account PDT. Small account PDT. So if we just do 3 round trips in a week, we're okay. We'll stay away from the purgatory of PDT. Active income means we're flat at the end of the day. Okay, so that's a little bit of background. That's some context of what we're trying to accomplish here. Now let's talk about our 0 DTE options. These are options that expire today. Now, we've heard about weekly options for quite some time. Here's Microsoft. You can see Microsoft has got a Friday option coming up in a few days. And then next week has got another Friday option and then another Friday option. And so these things are the greatest thing that ever existed back in 2006 when they first introduced. But now it's kind of old hat, right? It's, oh, you only get 1 expiration a week. Now we're kind of spoiled because we have the S&P, which is, as of May, 5 weekly expirations. So you can see today, Tuesday, Wednesday, Thursday, Friday this week. Next week, Monday, Tuesday, Wednesday, Thursday, Friday. And every week now, they kind of dip their toe into the water. We've had Monday, Wednesday, Friday expirations for quite some time now on the S&P and the spiders. And then finally this year, this spring, they did first Tuesday options, and then they saw that the world was not going to blow up. And they finally added Thursday options last month. Hallelujah. We now have 5 days a week where we can trade options. And as you'll see, That's an option with a 0 after it. That's a 0 days to expiration. This option will expire today after the closing bell. So that's the S&P 500 SPX. We also have the spiders. They're going to be a little bit behind. They're still 3 times a week. You can see Wednesday, Friday, Monday, Wednesday, Friday. And then also the Qs are the same thing. The Qs have Monday, Wednesday, Friday. We also have the NDX. I'm not a big fan of the NDX, but there's other options that are out there which are traded at least 3 times a week. But for us, we're going to focus on the S&P 500 and the SPX. And then if we have to with smaller accounts, we'll use the spiders. So again, I expect to see the spiders add additional Tuesday and Thursday option before too long. Now, what's great about these options is that they expire today. So it's almost like we're holding an ice cube in our hand and we're walking towards this raging fire that's over there. So imagine this is a raging fire and the heat transmitted to that ice cube is a function of the square of the distance. So the closer that we get to this raging fire, the more heat that it's going to feel. And so what happens with this option is that it's going to decay very, very quickly as we get closer to, in this case, this is expiration right there, that closing bell. So that's the neat thing about these things is that we're selling a wasting asset for most time, or we can buy it also. Now, understand that these are very sharp instruments. And the analogy that I use with this is imagine that you're a baseball player or you're working on your baseball game. You're a kid and you could go to the local, game park and there's batting cages there. And you can, insert your quarters and then you can get 10 pitches against a certain machine. Now, these things usually, they start up maybe like 40 miles an hour. The next cage has got 60 miles an hour. The next cage is 80 miles an hour. And it's obviously a lot harder to hit an 80 mile an hour fastball than it is a 40 mile an hour fastball. And so the problem is I don't want people coming in with little experience trying to hit that 80 mile an hour fastball because things can go sideways in a hurry with that. So this is something, again, that I think you need to work up to. If you're trading options for the first time, start with something a little slower, maybe a month or a week in duration before you get down to the daily, because you're up against the best in the world. Never forget that. There is no AAA when it comes to trading. There's no bucket shops anymore. So very sharp instruments, these 0 DTEs, but this is where the opportunity is. So let's go into some examples here. Let's start out with the simple directional trade. We're seeing more trend days than ever in this bear market. How can we take advantage of it? Now, a trend day is that where it starts down here and it ends up here, or it can start up here and it can end down here. This is where we get those big daily candles with a lot of price movement in them. So trend days are like this. We see these great big candles, they gap and they run and they keep on running all day long. So a trend day is where we get a large daily movement. And these are especially prevalent during bear markets. People don't understand that we get a lot of range days during bull markets, but a lot of trend days when we have the fear of the bear market. Now, what's great about these options is they're extremely responsive. I'm not going to bore you with the details here, but the at-the-money gamma gets extremely high in expiry day, which means an option's value can literally explode in value as it moves in your favor. It can also work against you too. It's a double-edged sword. Now, we can use long options for this, and this is where a lot of newer traders like to trade new options, but man, on the SPX, this is a commitment. You can see some of these are at-the-money options here, and these are, I just took this like an hour ago, the screenshot. We're talking about $900 options over here on the call side, and we're talking about $1,200 on the put side. So these are not inexpensive, and those will go to zero by the end of the day, those that are slightly out of the money. So movement is a double-edged sword. What I prefer to do is use vertical spreads. We're going to use a minimum spread width of $5, and we're going to play these at the money. We're going to limit our reward. We're going to limit our risk. We're going to use this as a directional instrument. Whether or not we use credit spreads or debit spreads with this is immaterial. It's whatever you're comfortable with. So it offers a much more risk-controlled directional experience with the possibility of winning, even if the price doesn't move much. So we can enter the trade, and if it just moves a little bit, we're going to see the decay start to match this fairly soon, and it can work in our favor. So allowing the price to trade just a little bit allows us to grab our fair share and get out of the trade. You can always trade these spiders as well too for much lower notional risk. So a trend day is going to be different than a range day. Again, this is where we use the opening range. We understand what's going on with the price. We track the opening range that's over here. The price trades above the opening range or below the opening range like it did over here. Then it's on a trend. It's moving into a trend. Like today. Today, we had the same thing. We had a trend day. At least we did until I started talking on this webinar. So we'll see. But the opposite of that is a range day where the price is staying, at least for a good length of time here, within the opening range. The opening range is the first 30 minutes of the trading day. So we're going to talk more about this in just a minute. So this is how we're judging a trend day. When we have a trend day, we want to use a directional trading strategy like what we talked about here. Typically, we're going to use a vertical spread for that. Now we're going to go into the whiz bang stuff. We're going to go into the short options, in this case, the Iron Condor. Now we can use the Iron Condor for range days. So you saw that example where the price set up in the opening range, and the price was just kind of doing this kind of thing, and then it stayed within that opening range if we project it forward for a good period of time during the day. Well, if that's the case, then we can use something like this, the Iron Condor, where you can see that as long as the price stays within this price level, these are price levels down here on the analyzer, and then we get a good range of price that as long as it stays within there, we don't even care what direction it goes. As long as it stays within there, we can grab our fair share, and this will decay by the end of the day to fit this risk profile, where the profits are on the top here and the losses are if it goes one direction or the other too much, right? So if it starts the trend, we don't want an Iron Condor, or we want to get out of our Iron Condor. Now there's different types of Iron Condors. A lot of people just focus on one. We're going to show you different types of them here. High probability, low probability, a one expected move. So if you've ever listened to any of the tasty trade guys, you'll hear about a one expected move. And so we've got one for those. And there's also the Iron Butterfly, which not a whole lot of people know about. All right, let's go into detail on each one of these. The high probability iron are what a lot of people like to start with. And the reason why it's high probability is because the chances of success are relatively high, at least 80% for the entire trade. So these are, we're setting up strikes up here where maybe there's a 10% probability that this will be in the money by expiration, and same thing, maybe 10% up here. This would be a 10 delta. And then if we multiply the two together, in this case, this would be approximately 80% probability for the entire trade. As long as it stays within this area, we're all good. So many like to use intraday technical analysis, leg into these. There's a lot of different techniques for this. A lot of people start with this type of Iron Condor because the implication is because it's, and I'm using air quotes here, safe, because the trades are a mile out on the money. This is almost like the analogy of, if you think about, here's where the current price is right now. You can almost think of these as like the front lines where all the, the battle is happening between the soldiers on both sides. And then back here, you've got the artillery. So these positions are almost, you can think of them as the artillery, where they're just sitting back behind the in the rear echelon, right? Just lobbing shells over at the enemy over here, and not particularly in any kind of danger, unless they get flanked, and then they're totally exposed. And that is the problem, because there's no defense for this. Typically, you're not going to have a whole battalion back here protecting your artillery. So that is how a lot of people start trading Iron Condors, with the supposed safety of the distance. But I think what happens in time is that as you get more experience, what you find is that you're more okay with playing at the front lines, because you get a much better reward to risk. You don't like those extreme reward to risk and high probability trades. You're going to sacrifice one for the other. So this will have a lower probability of success, but the risk reward is so much better. It's also faster when you're playing a low probability. So you're starting off with a 50% probability of success. But chances are, is if you can identify a good place for a range day, this is going to pay off very nicely with much less hold time. A low probability Iron Condor you can be in and out of there in an hour, versus a high probability where you're basically staying there all day long, waiting for your fair share. And then the expected move is just the wings are one expected move away. And so instead of a 1-to-1 or 50%, this is a 68.2% probability of success within here. So it's the middle of the bell curve, if you will. So this is a very, very popular one by those that trade statistically. And then there's also the Iron Butterfly. If we take an Iron Condor and if we jam together the short options right in the middle, if we trade the short put and the short call right there at the price, and then buy wings out here, so a long put and a long call that's out there, it's the same thing as an Iron Condor. We've just made it infinitely narrow at the money. So again, the big advantage for these is, again, risk reward is great. The speed is phenomenal of these. Creates profits much faster than other versions of the Iron Condor, yet has a smaller range. Not going to get everything, right? There's no perfect trade, but there is a trade that's best for the environment that you're in. So which one do you trick? Which one do you trade? So high probability, slow, low paying, best for those that can't actively manage a trade. Will usually take all day to harvest enough premium to make it worth it. Low probability is the tightest range, but fastest to profit, because short options are closer. So it's a good compromise, since the width is still pretty good and it's reasonably fast. Expected move condors are a compromise. Again, it takes about maybe 3 hours to earn $100 on the SPX. I can actively manage risk if I step in front of a trend day. And then we finish up with the Iron Butterflies, the fastest version of an Iron Condor, and actually my favorite if we're in the right type of environment. If we have a nice range day, then the Iron Butterflies are my choice of weapon. Anyone can enter an Iron Condor. The skill comes in knowing when to enter and when and how to exit. A great offense is your best defense. So avoiding trend days is the key. So remember, when we talked about trend days, we want to see a range day. We want to see the price set up the range and then continue to trade within the range. And then we'll take one of these trades. So to me, which one is better? I've gravitated over time towards more narrow trades, because to me, time is money. I don't want to be sitting around all day long wondering if I've won the trade. I'd rather be done by 10:30 in the morning. An hour is a good day to me. I've got plenty of time to do everything else that I want to accomplish. And don't forget that if you lose a trade on one of these, there's 4 more days remaining to trade every week. You don't have to bury your head and say, oh no, this is terrible. Guess what? You get to hit the reset button and start again tomorrow. Very, very important. So those are Iron Condors. Now, I'm going to go through this next section very quickly here. These are calendars. These are not really for this type of market environment. A calendar works best in sort of quiet, rangy, very small range markets. Now, they can function in higher volatility, but it really kind of works against this. Trading a calendar will actually make you much, much better because you have to think in more than one dimension at a time. So first of all, what is a calendar? Well, it's when we're selling today's option. So we're still selling that 0-day option, but we're going to integrate a back option, which is about a week further out. So we would sell, say, maybe so we're going to sell maybe the 621 option for today. And then we're going to buy the 628 option at the same strike price. This is what makes it a time spread or calendar spread, because we're selling different times. Whereas at a vertical spread, they're all today's options. So this is what makes them different, makes them a little more complicated. What's the edge here? Well, think about this. If we're buying that back option, which has got another week left to go, remember this option here, remember that fire, it's going to go to zero by the end of the day. But that option that we bought is still going to retain most of its value. It's still got a week left to go. It's still got another, in this case, 6 days to go, 6 calendar days. So this is the differential. This is where the profit comes from in this. This retains its value, or that's the idea, and this eliminates all of its value. So we keep the spread between them. The important thing here is that this is a fundamental edge. This will never disappear. So this trade will work today. It will work a year from now. It will work 10 years from now, unlike some strategies that seem to find edge in a specific type of market. However, you do have to be careful about what type of market that you use this in. So what are the risks? The risks can be things like shrinkage. Now, you're used to, with a vertical spread, you're used to seeing this expiration graph remain constant. So it doesn't matter what happens when you trade a Iron Condor, that expiration graph will remain no matter what happens with time, price, or volatility. What happens in between then is with the variable risk graph, and that will change, but the expiration graph will not change. Guess what? With a calendar spread, this will change quite a bit. We can see shrinkage where this entire envelope can actually start to wind down. And that makes it tougher because all of a sudden you had all this room to make a profit, and now you have very little room, and it actually will go underwater. So we have to understand what makes that happen. And trend days are bad for trades like this because we don't have that much room to, it's like an Iron Butterfly. We want to make sure that we're in a range day. Now, one thing that's cool with these trades is that we can, if we step in front of a trend day accidentally, we can turn a single calendar into a double. Now, well, that may sound like a panacea, like, oh, perfect, I can never lose. Problem is that all of a sudden these options are way out of the money now, and they'll be much slower. Also, we had to use twice as much capital for this trade. So there's always a cost anytime you make any kind of adjustment. There is a cost to the trade. But this is a good way to adjust for a trend if we get involved in something where all of a sudden it's like, oops, it began its time as a range day and now it's turned into a trend day. So what you find with the calendar spread, it becomes an accounting exercise because you're dealing with all these different options. You're dealing with different volatilities that you have to track between the front and the back options, the debits, the risk that you want to maintain for the trade, things like that. And so we do have adjustment points where we can take a single calendar, turn it into a double calendar. And then that double calendar, if the price keeps on moving, we can actually turn it into a single calendar again. We can keep rolling the thing and moving with that. But this requires a very sophisticated sheet that tracks everything and basically acts as the computer for this trade. So I use a purpose-built spreadsheet to make these decisions so I can kind of automate this. Otherwise, it's very difficult to figure out how to adjust one of these, but it's much more simple with a sheet like this. Condors versus calendars, and then we'll move on here. Condors are easier to qualify, can create more distance to create a more hands-off trade, but the payoff is it's slower. Trading below an expected move of plus or minus 15 points, which we may not see again for another year, can be tight. Calendar spreads are much more rigid qualification. There's more variables to pre-qualify and get right before the trade. Like I said, it's going to make you a better trader if you go into this. There's less distance for price movement, but the benefit is faster profits. So it's much more appropriate for quiet markets that show the potential to transition to more volatility than the other way around. So we're not going to see that for a while. Maybe into the summer, we may have an opportunity to trade the calendar. So those are the calendar spreads. Now let's talk about charting. What technical charting tools do we need to help us with these zero DTE trades? What type of studies? None. We don't use studies, and I don't think you should either intraday. So no lagging study that I'm aware of will help you anticipate or forecast intraday price action potentials for a zero DTE trade. Learn to use the price to frame in the battlefield. Keep it simple, guys. So we can use things like price gaps. If we have, like, here's an example of a price gap where the price just gapped straight up there, made no attempt to fill that gap whatsoever. Here's another example. Price gap, made no attempt to come back up and fill that gap. So the S&P will gap up and down every day as it gaps track what yesterday's closing price was and whether or not the price is interested in filling that gap. If it's gap and go, you might expect to see a trend day. Therefore, you might expect to use a directional spread. So price gaps can be important. Of course, we use the opening range, as I've talked about before. The opening range will tell us essentially whether it's a range day or a trend day. So here's a couple of examples for this. These are recent. Here was a trend day. We started out the opening range, and it wasn't long before the price starts to trend below the opening range, and it went even below the expected move for the day. And that was a big time trend day to the downside on 5/18. Here's June 9th. June 9th started out trending to the downside, but it turned into a range day for at least the majority of the day before a late day sell-off. So that's kind of like a multiple day. The opening range is determined by the price range the first 30 minutes. And typically what I'll use is a study by Thinkorswim that just maps out that price range in the first 30 minutes, makes it automated for me. So the opening range, or you could just fill it in yourself with a rectangle drawing tool on your charting package. What we also look for is the expected move. When we have the opening bell, there's going to be a plus and minus expected move, which you can read right off your option chain of your broker, plus and minus right there. And so we'll take that opening print, add and subtract the expected move. So here's the plus expected move. Here's the minus expected move. And that gives us the price range for 68.2% probability that the price will finish within that range. So what happens is these expected moves, everybody sees them. Everybody knows exactly where they are during the day. Anybody that does any kind of trading, the professionals will know where the upper and lower expected move is for the day. And they tend to be support and resistance, especially during range bound day. So we'll get a range bound day for a while, and then we start to trend, and then it bounces right off of there. And we see this happen all the time. Every day we get reactions at the expected move. Even got that this morning. So guys, I would say keep it simple when it comes to analysis. Use the KISS principle. You can't predict the future. I don't care what anybody says. Do the best job that you can to avoid being trucked by a trend day if you're selling options. Conversely, you can leverage the volatility of a trend day with directional trades. But you can't win from the sidelines, right? You definitely will lose if you wait for everything to feel good. A lot of people, they're waiting for everything to feel good, and then by then it's too late, right? Keep it simple. Remember that these trades show up 5 times a week. So if you get knocked down, get back up again. get in the fight. But, you know, we're actually doing quite well. We're winning more than 90% of our trades on the Iron Butterfly. So not too many knockdowns. So here's some examples I want to show you guys here. Here's we'll start with the calendar spread. And again, we don't do a whole lot of these. We did a lot of these in the summer of 2020 because it was a perfect environment for this, with the implied volatility kind of very quietly eroding. And so we placed a lot of these. Here's a good example, 7-minute hold time for $125, 7 minutes. Here's an expected move Iron Condor. This one, we looked for a $50 profit target. We're risking about 330, so that gives us 15% return on risk. 78-minute hold time, kind of long. Here is a low probability Condor. This one took about 107 minutes, a little over an hour and a half. And we're looking for, again, $50, 20% return on risk, slightly better return on risk with this one. And these not super quick. Here's a directional spread that we took recently. Here is, we started off, remember what I talked about. Here's the opening range, and the price was gone above the opening range. And here's the retest from above. Boom. There's our entry right there. And this was $55 per contract, 0.28 R. So it's not a bad return on this, 55 minutes. Very simple trade. Very simple trade. Probably could have had more if I'd waited a little longer, but that's always the case, right? And then lastly, Iron Butterfly. This is my favorite. When the right conditions are there, this trade cannot be beat. So again, June 9th was a really nice range day that we had, which is hard to find these in today's market. So we have to be patient, wait for the right days. But this one was, took a little longer than normal, 78 minutes. Typically I'm out of these things in about half an hour, but $100 per contract profit, or in this case for 2 contracts, $200, 25% return on risk, 25R. And the performance of these, like I said, in 2021, we were almost unbeatable. We had 108 winners out of 111 for 97.3% rate. Profit factor was 6.9. For every dollar we lose, we make 690. In 2022, currently we're running 46 for 51, which is over 90%. And this is running with a 12.34 profit factor. So for every dollar we lose, making 12.34. So that's the kind of odds and the kind of system that I like. Okay, so that's what we're doing right now. Okay, so those are recent examples. Let's put it all together, get you wrapped up and get you on your way here to the next session. In my mind, there's one narrow path to success. Again, I've talked to literally thousands of traders. We're all coming from the same place. We're all trying to get to the same place. To me, there's only one narrow path to get there. And it all comes down to how the human mind accepts and processes risk. So make the shift to an income focus, learn options, apply zero-day strategies, stay small until you get good at this, where you can start to open it up and get that 1% a day. So remember the things that we talked about here today. Growing your pile. Don't focus on trying to grow capital that you can't create passive income from using traditional methods. Focus on creating income today using passive and active income from options. Options offer limited risk, high probability trading strategies requiring far less capital that are risk controlled than stocks. The cost is knowledge. You guys know that now. $100 a day. Don't try to climb the mountain all at once. Focus on a repeatable, modest goal so that you can gain confidence and mastery. Let that compounding work for you. Get better every day. Use zero-day options. They have a 6.5-hour lifespan. They display very specific characteristics for time decay and gamma. They're available 7 or 5 days a week now. Learn how to trade Iron Condors. Find the style that meets your requirements, master the application of it through entry, defense, and exit techniques. Or use calendar spreads. It will teach you to analyze and think in several different dimensions at once. More edge, but more capital and more knowledge required. Best for low volatility markets. We're not there right now. And again, of course, trade small to begin with. The SPY offers 3 times a week opportunities of 1/10 the capital required as the SPX or NDX. So no matter how large your account is, this is where you should start. Repetition is the mother of skill. Okay, so we put it all together. Let's wrap up now. So it's my belief that everyone needs to shift to an income-based focus and ditch the old financial income paradigm that no longer works and is only for the dinosaurs. You might be wondering how you can get started. It's great to feel motivated towards the direction. You might not have the map to get there. So I would say consider joining our community at ReadySet.trade. You can join for free, you can become a member, or you can buy a class today if you want. We provide the structure and guidance to show how to quickly come up to speed on these zero-day strategies, plus all of the other intangibles that are necessary for success. I love this quote. Goals are for people who care about winning once. Systems are for people who care about winning repeatedly. This is what we're all about, is systems. So what we do at ReadySet.trade, we've got a live trading room. I'm on live for about an hour a day every morning. We have a 5 times a week daily newsletter. We have a live online community. People can ask questions of each other. We have live trade notifications when we take them and adjustments when we take them, multiple trading courses and strategies and techniques. It's kind of like a Netflix, right? You get all you can eat. You become a member and, you know, whatever you want from the service you've got. Okay. Now I'm offering the course alone. A lot of people don't like to subscribe to services. They're like, well, I don't want to get locked in or anything. Of course, you're not going to get locked in. But if you just want the course itself, it's $99.99. This is a special for today. If you go out to the site, it's going to be $199. So today, if you go to ReadySet.trade/0, you'll be able to get to this course offer for $99.99. Okay. So again, our overall performance of the service itself, if you go into there, you can see the service itself. We have an 81% win rate. Profit factor is 2.38. This is for all the strategies that we do apart from the zero DTE, right? So we're also doing things like selling cash secured puts and Iron Condors, longer term basis. We're also doing, you know, all the simple cash flow strategies that we should be doing from passive and active income. But today, our specialty is really the zero DTE strategy. What's in the course for the zero DTE? Talking about the advantage of zero DTE options, talking about the different types of Iron Condors, different types of Iron Butterflies. We're also talking about calendar spreads and how to defend and enter and exit these things, zero DTE directional trades, as well as direction making, right? So how do we determine whether something's a range day or a trend day? It's very simple, right? So that's the way that we try to do this thing. Plus, if you get the course, you get member access to our free community, which we call the 10X Tribe. We have trade signals, which get thrown into the room. We've got some courses that we offer to you for free. And again, member access, you can ask questions to anybody in there. Okay, so that's what's going on. And the link again for the course today, ReadySet.trade/0. If you want to just become a member, you can just go into ReadySet.trade, sign up for a free membership, and you'll see what's going on. I don't know if I bring in this window, I don't think it shows. So I tried to do this a week ago and it didn't work. But anyway, that's essentially what we're looking at for today. Okay, I just lost my screen. Hang on a second here, guys. Okay, so there we go. ReadySet.trade/0 is for the course, or you can just go out to ReadySet.trade and become a member. We do have a special going on right now for membership, which includes signals as well too. So some of the questions coming in are, is this for new traders or advanced? Well, I would say the overall service is for newer traders. The ReadySet.trade service is for newer traders. Like what I said, the zero DTE represents a little bit more advanced because it does require you to understand what's going on. So I would say get involved with some of the slower strategies that we offer first. And once you excel at those, then you can move up to the zero DTE. So it really depends on how much knowledge that you bring to the game for that. But certainly something that within a few months, I think anybody could do. Okay. Any other questions for today? Again, I would bring up the site, but I don't think it shows if I bring up the site here. So I think it's fixed on one window and
Yeah,
one look.
you have to stop your share and then reshare if you want to do that.
Yeah, that's okay. So we won't do that, but everybody can look at, if you just go out to ReadySet.trade and just look around the site, you can see what you get for signing up for free. You can see what you get for signing up as a member, or we're offering the course today, again, for the 50% off at ReadySet.trade/0. So I hope to see you guys either online or in some other form, or you could certainly ask me questions if you want to. I'm at doc@ReadySet.trade. So I'll just do this here, doc@ReadySet.trade. So that is, if you want to email me with any questions, I'd be happy to answer that. Otherwise, please check me out in the course for today. If you're a free member, how do you get this special price? Well, if you sign up for the course, then you become a free member. So that's included also. So if you add yourself, if you join through the course, through the ReadySet.trade/0, then you also become a free member as well too on there. So you become a 10X tribe member. This is what we call it. And if you want to, you can always upgrade to the full membership. Okay. Any other questions? Anything else? Okay, David, I think we are set. Thank you very much. And it was always a pleasure to come here at Synergy Traders.